Welcome to another episode of the Legal Lowdown. I am your host, Matthew R. Carpenter, an attorney, and today we are recapping SEC enforcement trends from the week of July 7, 2025. If you're a new listener, the SEC, or the Securities and Exchange Commission, is basically responsible for protecting investors, keeping the markets fair. And what we're going to be looking at is a few different types of cases that they have either been settling or filing in the week leading up to July 7, 2025. Okay. So in that period, we have things like offering fraud, these free ride schemes that I'll explain later, charging improper fees, and also false statements. And it's really important, I think, to keep an eye on this stuff because these enforcement actions tell us a lot about how to maintain integrity in the financial markets and how the SEC is prioritizing that. And honestly, what's fascinating is how these complex-sounding actions often boil down to core issues, right? Like things like transparency and trust, which is what our financial system depends on to grow and thrive. So let's start with maybe one of the most straightforward types of SEC enforcement cases, offering fraud. Our first case is SEC versus Cheetah Inc. That's a zesty name. I like Cheetah Inc. I like that, like what you're doing. And, but too bad they allegedly cheated these poor people out of their money. But anyway, this newly filed case comes to us from the Southern District of Florida. It involves a scooter rental company, Cheetah X. That's a very zesty name for a scooter rental company. And they also went by GoX. And the SEC is focused in this case on the CEO, Debalov, and President Salam. So the allegations state that basically between 2021 to 2023, the duo raised about $4 million from roughly 300 investors. And here's the kicker. They told their investors that their company was basically fail-proof, right? In other words, they told these people that they could not lose their money and that they could always get out every cent that they put in. Sounds pretty good, right? Like almost too good to be true. Oh, and the complaint suggests that these investors were also guaranteed a 100% return on their investment. 100% money back guaranteed. So you cannot tell me that doesn't sound too good to be true. And this poor group of 300 investors, I think it was asked to invest about $2,000 to $30,000 each. In all, the defendants raised roughly 4 million schmeckles. But the SEC complaint points out that by late 2023, the investors, they received less than half of their money back. Nobody got the full return promised. So the complaint alleges violations of Securities Act Section 17A for using methods of interstate commerce to defraud investors, and Exchange Act Section 10B and Rule 10b-5 for making materially false statements in connection with the sale of securities. That case is ongoing. And it really just hammers home the old saying, guys, if it sounds too good to be true, it probably is. I learned this in like 6th grade. When people from foreign countries kept trying to buy my GameCube for like hundreds of dollars, but I had to send the GameCube first, and it was only worth like 50. If it's too good to be true, it probably is. All right, so moving on from those kind of impossible promises to something a bit more complex, maybe even exploiting the system itself, this brings us to a free riding scheme. This comes to us from a previously filed action, SEC versus Hernandez in the Eastern District of New York. And before I dive too deep into the weeds, I'll go ahead and explain what free riding is right now because it's really quite interesting. So free riding is basically when someone opens an account with a brokerage firm like Robinhood, for example. A lot of people use Robinhood, right? But the catch is that the person who opens the account doesn't have enough money to actually fund it. You see, when someone opens a Robinhood account, they have to fund it with cash. And Robinhood provides an instant deposit option for people to do that. Now, outside of that instant deposit option, if you want to take the traditional course and transfer money the old-fashioned way, it takes a few days, right, to move money into your Robinhood account, for example. But with the instant deposit option, Robinhood basically fronts you the money by giving you something called an instant credit. This is money that Robinhood puts in your account so you can trade while your actual money is making its way over to Robinhood. It's like a short-term loan or line of credit that Robinhood extends to you that is then immediately paid back to Robinhood once the money arrives in your Robinhood account. But this is the catch, guys. In a free riding scheme, the account owner is basically stealing that instant credit and transferring it to another account. The account left without the money is called a losing account, and the account that receives the money in the form of those instant account credits is called the winning account. In the end, the fraudster disappears with the winning account and leaves the brokerage firm with the losing account, right? They said that they were going to put $10,000 in Robinhood, but they only had $5. And they took that $9,000 difference and skirted off with it. That's what was happening in SEC versus Hernandez. The defendants engaged in free riding schemes starting back in 2018 that lasted for about 4 years. And they allegedly opened something like 600 brokerage accounts. Same old story. They'd use losing accounts to get the credit. Funnel it to winning accounts, potentially manipulate prices, and then just walk away, leaving the firms holding the bag. And defendant Hernandez, he was identified as the mastermind. There's already a judgment against him, and he's enjoined in order to pay back a lot, over $525,000 plus interest, as well as parallel criminal case restitution. And he's barred from opening brokerage accounts for 5 years unless he tells them about the judgment. Then he can open up the account, but you can guess that they probably won't let him. So, with such a complex scheme, the investigation must have been a truly coordinated crackdown. So from free riding, let's jump to something maybe a bit more common but still damaging: improper fees. Let's look at SEC versus Prisno. This one's in the Northern District of Illinois. This case lists as defendants a company, PE Capital Investment Management Partners, and its CEO, Prisno. Sounds similar to prison. Anyway, the core allegation here is that Prisno and his company from 2019 to 2023 charged clients about $2.4 million in fees. The case is ongoing, and Prisno has been charged with violations of the Advisors Act. That's all I got for you on SEC. That's all I got for you on SEC versus Prisno. Next, we have our final case, a false statements case. A false statements case, lying to the people. Poor people. You know, sometimes it's not just about fees, like in the Prisno case, right? It's about the risk that's involved. So this next case, SEC versus Kane, which is a settled case, by the way, it's already resolved, is in the Northern District of Illinois as well. This case involves Anthony Kane, who operated multiple mutual funds that he owned, along with investment fund portfolios belonging to other private companies. So he was running these mutual funds and then operating portfolios for third parties. And his colleague, Anish Parvantinani, participated as well. You guys can tell that I struggle with these names. I'm trying my best, guys. Collectively, these two somehow managed to lose over $1 billion. $1 billion. But let me tell you how they did it. While managing these funds and portfolios, the defendants told investors that they used a worst-case daily losses formula that created or resulted in a consistent risk profile for their investments. So they said that they were using this algorithm that ensured that losses wouldn't exceed a certain amount, right? A consistent risk. But in reality, the defendants relied on a short-term volatility investment strategy that allowed them to trade on margin, in other words, using borrowed money, to fund investments called out-of-the-money option contracts, which are basically just option contracts that are not guaranteed a return. The strategy came with significant risks that were obviously not disclosed to the investors, right? In fact, the investment strategies were tested at times, but the defendants never told the investors that the tests actually showed potential losses that could amount to 100% of the fund's value or more. And then in February 2018, the market wigged out. There was a huge volatility spike, and boom, over $1 billion vanished from the funds and the portfolios just like that. The complaint alleges violations of the Securities Act Section 17A, we talked about that earlier, and the Exchange Act Section 10B and Rule 10b-5, which we also talked about earlier, and the Advisors Act Sections 206, which basically charges the duo for using interstate commerce to defraud while acting as an investment advisor. So the defendants settled, like I said before. All of the defendants were enjoined. Kane has to pay a disgorgement amount of $1.5 million, pre-judgment interest in the amount of $630,000, as well as a $500,000 penalty. So nearly $2.7 million total are coming out of his pocket. And he cannot serve as an officer or director for the next 3 years. Jesus. A tapestry of lies that led to $1 billion loss. And I just want to take a moment to really emphasize this point. Guys, this man cost investors over $1 billion in losses, nearly 80% of what the portfolios and the funds were worth. And he was penalized with $2.7 million as part of a consent decree that didn't even admit that he was guilty. What? Where's the other 998 million, my guy? Honestly, this really just emphasizes the importance of having a quality attorney. Seriously, because that seems like a slap on the wrist in comparison to what he was facing or what he did. But anyway, wrapping this all up. So we've covered quite a bit today in this legal lowdown. Offering fraud, complex schemes, hidden fees, hidden risks. It's really a stark reminder. I keep telling you, vigilance and clear information are a must. Kings and queens. And what ties all these schemes together is really how they exploit trust, or maybe a lack of vigilance, right? Whether it's greed for a quick return or just not understanding the fine print. Like, it's important to stay up, stay woke. So for you listening, it's about looking for those red flags, the things that seem off, even if it sounds sophisticated. So maybe a few things for you to think about after hearing all this. First, how do enforcement actions like these, covering such different types of fraud, actually impact your trust in the market overall? And second, thinking about the specific cases, what kind of red flags might you look for now when considering an investment? Just something for you to think about. Thank you for listening to this episode of The Legal Lowdown.